9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to the show today. Counting down to the open of Greater China markets. Okay, let's try that again. I didn't get good sleep last night, and hopefully it gets better from here. Speaking of anxiety over the Fed outlook is the headline today. Stocks across the Asia Pacific slipping on those reasons about the pace of Fed easing after this week's priced-in rate cut. Traders on alert for any hawkish signals from the RBA with a third straight hold expected today.
A win for Nvidia as President Trump approves sales of H200 AI chips to China, with the U.S. to take a 25% cut.
Also ahead, China's politburo makes domestic demand its top priority after the meeting, Goldman Sachs calls it somewhat disappointing.
And Paramount launches a hostile cash takeover bid for Warner Brothers days after the studio agreed to a deal with Netflix.
Right, benchmark down, equity benchmark that is, U.S. futures on the way up. Digesting, is that the correct verb as far as the Nvidia news is concerned? It's old information. It's a new development. What does it mean for suppliers? Not much reaction. The Kospi is down 0.6%. That might also be down to the fact that when you have SK Hynix coming through on your next board, the Korea Exchange issuing a warning there on the stock, given the fact that it's up, 240%, if I'm not mistaken. On that note, we're also looking at other Nvidia suppliers in the region, TSMC being the biggest, although some of the other ones, of course, traded in Japan and also in Taiwan. Right. In terms of things to watch today, you have the dollar coming through, RBA rate decision expected to hold. Will it be a hawkish hold given the recent inflation print was on the hotter side of things? Speaking of hotter as well, copper is continuing to see its gains right now, and we're looking at copper futures in Shanghai coming up as well. 30-year futures, speaking of bonds, yields on the way up just about across the board. Chinese 30-year yield is down, though. When you look at that on the futures contract, that's about the lowest in about a year or so. Dollar China, and we are poised to see a slightly higher open going into the session this Tuesday.
Yeah, you saw Nvidia at least move after hours, and certainly it is a win for them. But you got to wonder how China's going to react to this, obviously, given the fact that, they've been kind of doing it on their own for some time now. Have we already reached that inflection point, or can we actually see a meaningful lift in Nvidia's China business? I still think there's a lot of debate over that as well moving forward.
Yeah, well, does China need it?
Yeah.
Yeah, right. And the other point was,
it's not Blackwell either.
No, it's not Blackwell.
Yeah.
And also Nvidia did say the assumption was zero, and then anything would be a bonus, right? So we'll see what that means, obviously, for the tech conversation there. Separately, there's this potential deal, Hollywood, this massive potential.
What a twist, yes.
Yeah, hostile takeover. And what does it mean for the likes of Disney and Amazon? Yeah, so we'll get into all of that, of course, in the show today. Speaking of the show, lots to watch out for. In fact, I think should be starting any time now. We're told when you look at the what's on deck today. Chinese Premier, there's 1+10 meeting. So you have the heads of a lot of the multilaterals. You have the IMF in play, plus many others are gathered, and I think there's a meeting taking place. Among the many things, of course, on deck today. There we go.
Yeah, we're watching CGB futures still here to sell, given what we've been seeing in the bond market of late, and certainly we're watching, of course, this Chinex rally in Shenzhen. Wanke, of course, the property space is still somewhat volatile. We're watching, of course, New World as well, given that they also are to defer payment of perpetual security as well. So watching New World here in particular here today. Copper, as Dave mentioned, we hit those records here. Some of it was some of what we heard from that politburo readout in December, so that helped at least copper spur another leg higher. And sectors to watch, of course, given the Nvidia story, obviously, is chips. We talked about the car sales factor and what this means really for the EV side of things. We're going to have Bloomberg Intelligence coming on here, and brokerages as well, a very good one, just given what we've been seeing in our taking stock here today. And we still are in window for some credit data as well.
Yeah, from today all the way until about 6 days from now. Right, let's get to the Nvidia story and bring in Annabelle Julius, of course, our tech correspondent, here with us to help us understand what you got us started.
Yeah. I think you guys actually got us started, but just to recap some of what you said there. So the Trump administration has decided to allow sales of the H200 chip to China. This is something that Nvidia has been lobbying for several weeks, if not longer, and even as Jensen Huang in Washington, for instance, last Wednesday on this very topic. So H200 is a chip that's specifically designed or well designed, has very strong inference capabilities. And inference is you're not training the model, you're not building those foundation models. Inference is really the deployment of that technology, and it's what allows AI to really be shifted or moved throughout the entire economy. It's something that will reshape businesses as well. So it is a very significant decision, and actually our geopolitics team or geoeconomics team has a really great take out on this, and they're saying that this is actually the sharpest pivot we've seen yet on China's access to this technology. I think the key question, and what we've been discussing all morning, is really, even with H200 sales, will Chinese companies be allowed to purchase? They weren't allowed to purchase H20, but at the same time, H200 is a significantly more advanced chip than the H20, which was designed specifically for the mainland market. H200 was on sale to US customers and others as last year. I mean, this year you're ramping up into Blackwell architecture. Next year you're ramping up into Rubin. So China will still be a couple of iterations behind. But at the same time, this is way more advanced than what they can get in China right now.
Yeah, and seen as, I guess, sort of a compromise from the U.S. Trump administration as well. Meanwhile, we're hearing from the president talking about, they want to do away with these sort of state-based AI rules. What would we know about that?
Yeah, this is another one. So he's quite active on True Social, obviously, President Trump. And the other one that he was talking about overnight is this rule book for AI, because this has been another sort of a complaint or issue with big tech in the US. And the way that it was shaping up was that you were having a lot of state-based regulations. So states were trying to protect consumers living in their own home areas. And so they were looking at rules to regulate the companies, again, on that state-based level. The US wants to move it to federalized rules instead. And that is also to allow companies to essentially be able to operate more easily instead of trying to respond to lots of different regulations, have one regulation instead. And I think as well, the Trump administration has been very clear that they've moved in that direction of less regulation, which again is what US big tech companies want to see. But it comes back to that bigger question of competition. And if you restrict companies, do you also restrict their ability to compete, essentially what you see from China?
Well, thank you. Annabelle Julio is there, our tech correspondent. Another top story that we're tracking, of course, is what happened in that readout that came out from the Politburo meeting back in December. Well, still in December, of course, right? But what we saw was senior leadership has set boosting domestic demand as the top economic priority for 2026. For more, let's bring in our chief North Asia correspondent, Stephen Engel. He's here right now on the readout that we got from the Politburo.
So there's many ways to read it, if you will, because it could indicate that they're very comfortable, essentially, with how 2025 ended up and transpired, because there were a lot of peaks and valleys, I should say, especially coming out of April, right? But they leaned on exports, even though there were some headwinds into the export scenario with those Trump tariffs. But yes, the Chinese economy has lost a little momentum in the second part of this year. But again, it's not falling off the cliff, right? So you can look at this readout as we're pretty comfortable. Mostly a continuation for 2026 of 2025 fiscal and monetary policy with a few caveats and a few twists. They're going to boost new productive forces with an indication as well that they're not going to rein in some of that overcapacity in manufacturing in key areas, strategic areas. So that's one way to look at it. Also, they added cross-cyclical policy adjustments into the verbiage as well, which means they're looking at longer-term planning, not just reaction to the current stresses in the economy, internally and externally. But essentially, as you just saw that quote from Xi Jinping as a readout from the Politburo, boosting domestic demand is the top priority, economic priority for 2025. Now, that doesn't necessarily mean we're going to get specific policies for household consumption. Domestic demand has lots of different levers in different areas, whether it's roads, railways, bridges, the typical cocktail of fiscal spending. But again, they're going to be looking at that domestic demand equation and adjust the levers accordingly.
So for those economists, and I had a quick glance across a lot of the reaction if you were focused on short-term measures, you didn't get it. You're largely disappointed. Is that an accurate representation of what's out there, so initial reaction?
Right. We look for the Politburo, then the subsequent Central Economic Work Conference, which will soon meet to basically take the tone set by the Politburo and put policy to it, start scripting the policy that will then essentially be ratified at the National People's Congress in March, right? So, again, we don't know what the specific policies are going to be, but the tone does not really indicate that there's lots of urgency to do policy response and fiscal stimulus or even monetary stimulus. Maybe a little bit. This is what Jacqueline Wrong, maybe we can bring up this quote. She's the chief China economist from BNP Paribas. Essentially, her assessment of this readout is they're going to stimulate demand and stabilize supply. Next year's policy outlook is likely to lean only towards modest easing, according to Jacqueline. Others have been a little bit more critical of it. Goldman is out with a readout as well. Li Xiangwang, the economist, saying they appear somewhat disappointing. The policy readout is somewhat disappointing. Although policymakers maintained their easing bias, they appeared less inclined towards broad-based stimulus measures. So that goes to your point, David. You know, the market, when the Chinese economy starts slowing down a little bit, everyone goes, okay, policymakers, where's the stimulus? Bring out the bazooka, right? They haven't done that. They didn't do that in 2025. And by all indications, if you read the dots and read the tone, no big stimulus is coming.
A lot of times it was not been said in these readouts, right? I think there was not really a direct mention of the housing market.
It was left out.
That's what Goldman said. Yeah. They didn't actually mention consumption. They mentioned domestic demand, but not consumption, household consumption, which is about 40% of GDP, right? Some say, like our old friend Stephen Roach says, they need to set a target. You set a target, they hit the target of 50%, he was suggesting. But again, nothing really specific on consumption, nothing on property.
Steve, thank you. Stephen Engel there, our chief North Asia correspondent. Still ahead, of course, we're talking about the battle for Warner Brothers turns nasty with Paramount making a hostile bid despite the studio agreeing to a deal with Netflix. We have NYU Stern School of Business, a professor, of course, joining us to talk a little more about what's next. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Today's move was entirely expected. We have a deal done, and we are incredibly happy with the deal. We think it's great for our shareholders. We think it's great for consumers. We think it's a great way to create and protect jobs in the entertainment industry. We're super confident we're going to get it across the line and finish. So we're excited.
I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market.
Yep, that was President Trump and Netflix's co-CEO Ted Sarandos there after Paramount launched a hostile takeover bid for Warner Brothers at $30 a share. That bid valuing Warner now at $108 billion plus debt, and it comes just days after the storied Hollywood studio agreed to a deal with Netflix. Now, Paramount's bid compares with Netflix's offer of $27.75 in cash and stock for an enterprise value of just under $83 billion. Meanwhile, Paramount's offer is for all of Warner Brothers, right? While Netflix's offer is for the Hollywood studios, HBO, and the streaming business. So that's kind of how you break it all down. For more analysis, let's bring in Paul Hardart, director of the Entertainment, Media, and Technology program at NYU Stern School of Business. Professor, it's great to have you on. Thanks so much for joining us. I know you've been able to see the two sides and the two different bids that are going on right now. Obviously, what a plot twist that we've been seeing unfold, almost like a Hollywood drama in some ways as well. How do you look at it right now? Which one is the sweeter offer, I guess, for Warner Brothers?
Well, they're not really apples to apples comparison, right? Because as you pointed out there, Paramount is offering for the whole for everything, including the cable networks, and the Netflix offer is really just for the streaming service and the studio. So I think they're different in that way. They do have an agreement with Netflix. There are breakup fees if neither one goes forward. So there are sort of penalties or disincentives for them not to go forward. I think it'll be interesting. What Paramount is doing is smart, is they're going directly to the shareholders with a all cash offer. Clearly, they've signaled that they have a good relationship with the current administration in Washington that will help sort of ideally streamline any regulatory concerns. So that's the way they're presenting their offer. My view is that Netflix is going to have to make concessions as it moves forward with this deal, and some of those concessions may be to the benefit of Paramount. They could maybe sell some of these assets to Paramount.
Okay, well, Paul, David here. What do you think happens then?
Well, I think what happens now is we are going to go through this period. Warner Brothers is going to look at the offer. There is a $2.8 billion fee for Warner Brothers if they walk away from the Netflix deal. So I think that would have to get factored into it. I think the thing that is worth noting is clearly, Warner Brothers stock has gone up almost 3.5, fourfold since these conversations have started. So it is interesting that Warner Brothers has been there for a long time, but all of a sudden now there's interest, and once you have two parties interested, the value goes way up.
And you mentioned about the breakup fees for Warner, for Netflix. I mean, they're willing to pay up, right? $5.8 billion. If this deal doesn't go through these regulatory issues. I mean, how are they going to get across that finish line in some ways? Which deal do you think is more likely to pass that regulatory scrutiny, Paul?
Well, I think they're both going to make the argument. Like you showed the clip there of the president talking about the percentage of the market. It's all how you define that. I think Netflix only makes up about 8% of all television viewing. And like I mentioned, they are all now looking at YouTube as a real competitor, and YouTube is a different service. And I think that's the process they're looking at. So if you think of a customer or a consumer has a certain amount of attention, and where is that attention going? It's going to TikTok, it's going to Instagram Reels, it's going to YouTube. And so, measuring it just as TV viewing or streaming viewing may not be the best way to measure these things.
So, Paul, if, let's say, Netflix got what it wanted, fine. If they had to pay a little bit more, fine. If Paramount then get, let's call it the rest of the assets. Let's play that scenario forward.
Sure.
What does it mean for competition? You mentioned YouTube. Let's go Disney and Amazon. How does the industry look like in 5 years' time?
Well, ultimately, I mean, I think this is a signal toward a shift, right? We talked about the streaming wars. Effectively, the streaming wars, this could be the conclusion of what we call the streaming wars. We're moving more to this world of sort of super aggregators. It's ultimately, none of these deals going through is ultimately going to be great for the consumer. It's not going to be great for the ecosystem or the creative community of Hollywood, but it also feels somewhat inevitable. So I think what you're seeing is we're going to have more and more of these large players, Disney, Netflix, maybe Amazon, and maybe YouTube, all competing for our time and attention. And I think that's the bet that they're making.
And just to pick up on that, Paul, why do you think it won't be good for consumers and the quality of content, if that second point is what you're alluding to as well?
Well, I think, in any business, generally, when you have consolidation, right, that reduces the number of choices, right, and that gives power to fewer players that then can raise prices and are not incentivized to innovate and bring in new content, generally speaking.
Yeah. Can you tell, President Trump has kind of, in some ways, weighed in a bit. I mean, we take a look at this Paramount bid. It's backed by the Ellison family. They are allies of the president. I think some of the equity backers are, include Jared Kushner, his son-in-law's PE firm. What sort of influence do you think the president is going to have on this deal?
Well, the president, it does come from, to some degree, a media background. I think he's very interested in this deal. I think he also likes having a voice in this. This deal does not involve the FCC because there's not a broadcast network involved. So I think any influence is going to be more around a monopoly, and both studios would have to make a case. What you are going to see is the end of a Hollywood studio to some degree, whether it goes to Netflix, whether it goes to Comcast, whether it goes to Paramount. And I think that's a shift. But it is how you are measuring, like we said earlier, how you measuring what monopolistic power is. And I think the case that Netflix is, there is some, Ted Sarandos apparently did meet with the president earlier this week. So I think, like we mentioned, the breakup fee, you don't make a $5.8 billion breakup fee unless you think you can push this through. They are going to have to make concessions, probably the theater owners, probably to the creative community of the guilds, and also probably it may involve some degree of Netflix and also how they window movies for theatrical release.
So, Paul, who needs this more? Does Netflix need this more, or does Paramount need this more for their future, existential future?
Existential, I would say, just based on the very large offer and the aggressive offer that Paramount has made, I would think that Paramount probably needs this more in the near term. Paramount Plus does not have the penetration that Netflix does. Netflix could take that money and invest it in content and probably continue, move on in a very pleasant way. So this is mainly a play to get some iconic content for Netflix in the near term. So I think Netflix could survive much easier. I think for Paramount and for Comcast, it's a little more existential.
Paul, fantastic. Thank you, sir. Paul Hardart, their Director of Entertainment, Media, and Technology at the Technology Program at the NYU Stern School of Business. Watch the space, as they say. Right, Hang Seng Index going into the open today, 7 minutes away from the opening bell. Slightly to the upside, although inconsistent, and with what we're seeing as far as futures go. So let's call it another flat session. We'll see what happens. This is the China Show. All right, just a quick glance at the approach to the opening bell today. So apart from, we're done with the earnings season and clearly lack of catalyst there. We do have some idiosyncratic sector stories. Case in point, brokers had a very good day yesterday. We have a piece out that extrapolates that into perhaps what we will likely still see going into next year. Cars, you had, again, disappointing numbers coming out of the industry. And apart from that, copper's at new highs, so certainly want to watch apart from that. But yes, apart from that, it's really not much to tell you about at this point.
Yeah, we'll check China chips, though. We'll see how that's faring, given one of our top stories is, of course, President Trump allowing Nvidia's H200 exports to China. And yeah, you are seeing a bit of reaction there, a negative one, from some of these domestic players in China. More threads, of course, that just listed here this week. We're down about 2.5%. But yeah, how much? I mean, it went ballistic there the first day.
Yes, 400%.
Yeah.
So let's call it splitting the difference.
Coming off.
A little bit, yeah. It's like a haircut. Take a little bit off the top.
A snip.
2.5%. Okay, we will leave you with a look at some live pictures coming through out of Beijing, where you have the 1+10 dialogue. Looks set to start as we go into the opening bell separately, and you have, of course, the Chinese premier alongside the 10 heads of what seem to be the 10 multilaterals. Of course, those are the big banks that span across continents and mandates. Plenty more ahead on that and the markets. This is the China Show. Welcome back. You're watching the China Show, counting down to the Tuesday session. And like most of my outfits outside the telly, uninspired. For anyone that knows me, it's probably the same thing every day. And just by Yvonne's reaction, you know that is 100% true.
His signature staple is the plastic bag, carrying his wallet.
No brand.
Yeah. And maybe some athleisure. That's the most of it, really, right?
With one set. That's it. That's it.
But we'll still try to make this interesting, right, when it comes to markets here. Obviously, we have the Nvidia news. certainly what it means for the China chip plays. It could be a bit volatile here today, given the fact that President Trump has now finally given that green light for Nvidia to export these H200 chips to China. So we already have seen some of these chip plays in China react a bit negatively. You are seeing the likes of Capricorn Tech down some 3%. We also had that readout from that politburo meeting for December, right? And seems like there was a pretty upbeat tone from the top leadership here, and the lack of concerns when it comes to the slowdown in growth that we've seen heading into the fourth quarter, of course, is something of what Goldman Sachs is disappointing, that maybe we might not see meaningful stimulus for next year. So maybe that's why we're not seeing that much reaction when it comes to markets here. We're slightly under pressure here when it comes to onshore, where CSI 300 is down about 0.25%. Bonds are ticking a little bit higher here. We're seeing yields down about 1 basis points on the 30-year yield as well. So we're watching that very closely here. And of course, we're still watching the likes of copper, right? So we hit a record on the back of some of the policy that we saw from that politburo meeting. Actually, copper prices hit another record here. We're seeing just a little bit of upside there when it comes to the futures in China here today. Flip the boards and see how Hong Kong is doing. Certainly when it comes to the tech space, that might be under pressure here today, just slightly. Not much in terms of movement here today. Of course, it is, the day before the Fed. So certainly there is a lot of anticipation around that. And then, of course, you watch very closely what's been going on in the property space. Seems like we're seeing Hang Seng property slightly lower here today as well. There has been some news about New World and deferring a payment there on some of the perpetual bonds. So that certainly is another thing to contend with in the property space. But also, when it comes to the tech space, we're pretty mixed in terms of reaction. Alibaba is actually still up 1.5%. Meituan, Baidu are lower. Tencent, Xiaomi, just slightly higher here right now. 707 for your dollar China, still seeing some strength here today. I guess the biggest sort of most obvious sector to watch, we talked about the car sales. That was also another weak picture, but we didn't see that much movement in the stocks in the pre-market. Is the chip space, though. That could be where you're seeing a direct impact from this whole Nvidia news as well. And there you go. You are seeing the likes of Hua Hong Semi down some 3%. More Threads also down about 1.5% here. Just a slight reaction there too, Dave.
Yeah, it's been quiet across these markets. We've had a lot of news flow, though, today. Interesting, we're not really getting the market to react to it. It's really been an eventful year. In fact, just I think on that note, right, we're wrapping up with a couple of weeks left here before we wrap up, if not already for some houses out there. Right, so first time in 8 years that we've seen a performance spread between, let's call it MSCI China on one, you take the spread annual over S&P or even the global stocks, right? So MSCI China set to outperform the S&P for the first time since 2020 by this amount since 2017. That's point number one. Point number two is it's really been a story about a reversion to the mean as far as the PE goes and valuations, right? In fact, we're now slightly higher than the historical average because of that sort of multiple expansion, which also shows you that at some point earnings will need to show up to bring us back down slightly. Joining us here to wrap up the year and to look ahead to the new year, Michael Liang, Chief Investment Officer at Foundation Asset Management, here with us on set. Nice to see you.
Thank you. Thanks for having me.
I think we last spoke probably May, a few months ago.
Yeah.
Lots has happened since then.
Yeah.
So how do I look at what's happened this year, and how does it inform me about how we do next year in Chinese markets?
First, I like this new setting. It's
Oh,
a lot more
good.
friendly.
Glad you like it.
I'm glad you noticed. Some people walked in and they were like, what's new? I'm like, well, okay. But yeah.
Well, this year has been a story of valuation expansion, right?
Okay.
If you look at the PEs right now for Hang Seng Index, about 13.5 times, about 80, 90 percentile here. So it's not cheap on the historical, perspective. CSI 300, of course, is always slightly more expensive than Hang Seng, but given the domestic government support and everything, and liquidity, I think it's probably reasonable to say at these valuations. But I think Hang Seng probably will face some downside pressure next year.
How much downside?
Well, it's very hard to tell, but I would say downside could be 10, the upside could be 5. So the downside is probably twice as much as the upside risks.
Okay. Why is that?
Well,
just because we done well? Or?
Yeah, number one is valuation.
Okay.
Number two, I think we got through the first phase of rally. If there's a second phase, we need to see earnings to catch up, right? But look at the, recently I've heard some news on the banks, regarding banker situation. And then, of course, domestic consumption has been on the weaker side, subject to government stimulus. And then you have these subsidies for EVs and home appliances. Are going to taper off next year. Maybe reduce, maybe totally, taken off. Year-on-year comparison going to be hard. And of course, you got the e-commerce sector, right? They compete like crazy for market share. But in my opinion, it's fighting a losing battle here because the overall consumption as a whole, that pie is not growing. Are you really fighting for the market share of it? I mean, what's the end game of this?
Do you tilt more towards the A-share market than onshore? Are you getting better risk-reward there?
I think there's a lot more growth stories there, right? Like you mentioned, there are chips there, there are new energy, there are a lot of different themes at play at A-shares. But in Hong Kong, still predominantly driven by financial sectors and telcos and oil companies. That's not very exciting.
It was, going into this year, it was easier to pick the winner of a sector, and that name remained the winner, right? So I think, not to name names, but you pick a sector, number one market share, they're likely going to be the winner. What's happened this year, to your point, they spent so much to defend that market share that's falling. I believe long short, as you mentioned, is the way to go next year.
Yeah.
Long the winner, shall be short the losers. How do I find out, what criteria do I use to figure out who the winners are?
Yeah, I think the easier way is not making an assumption of the economy going to continue to grow.
Okay.
Or the pie will continue to grow. I think I'd like to make an assumption which company will be able to take a market share without sacrificing margins, which is a very tough job.
Especially now.
Especially now, right? Because the pie is just not expanding. Well, given an example, probably everybody will understand, in my opinion, the Nvidia story is similar like this. They're defending the GPU market share. And then you have people like TPUs coming out from Google and from AWS, right? Yeah, sure, the industry is still growing, but Nvidia, its gross margin is about 60 to 70%. The rest of the AI plays, including the hyperscalers, their net margin is between 20 to 30%. So Nvidia net margin is about 30% higher than the rest of the crowd. To me, that's an invitation for competition. You have a situation, back to China situation, you have a situation like this, right? When you have such a higher margin business, not so high in China, not in the 30s or 50s, but still, there's still a lot of liquidity, but they want to compete. For example, recently you have some competition in auto glass, such a dinosaur business. Why would you go into that business? Because the margin has to be, because the industry has been consolidated for so long, there's only a couple of players has a very dominant market share with a very, I wouldn't call it fat, but reasonable margins, about 20%. And the other guys look at, my net margin is 5, 8. This 20 is very enticing. So let's pile into that. And then, I'm not saying the oil crash down, but I'm saying the margin will be reduced because of that. So then, talk about 2026, if you continue that thought, you see will be increasing competition, margin under pressure, so there will be less winners, potentially more losers. That's why I'm saying potentially you might see more downside than upside here.
Do you see, can you give us an example of a company that is maintaining market share and its margins right now?
If we can talk about names or generally speaking,
Theoretically speaking.
Theoretically speaking, like the companies with a very sticky business model. For example, Tencent.
Okay.
Their social network is so sticky, you hardly can move away from it because you think they charge you too much or there's too much advertisement. You cannot move away because the rest of your friends are on it. So that kind of a business, they have a pricing power and a very little competition. There's someone to create another WeChat ecosystem tomorrow is not possible.
Okay.
Especially in this environment. For a company like that, with a very sticky customer base. Technology advancement, innovation is great, but I think the name of the game for next year is about having a very sticky business model, very solid subscriber or customer base.
It's almost like picking a monopoly, but and that's the extreme concept, of course, right? A company with high barriers to entry. You mentioned Nvidia, but not everyone can become an Nvidia, right? It takes many years. A lot of people arguably can make, car glass easier. But so we're back to the same point in terms of just being able to figure out which companies do have that sort of sticky power, whether that's the sector, whether that's the product? And do you think in an economy that is not doing as well, that remains the strategy to go?
I think still, I mean, I'm not saying...
And if the economy turns is the question too. Like, how does that change the thesis?
Yeah, I think still 2C business is easier to figure out. It's closer to us. You know, we have a sense of feeling or gut feeling towards what's going on in the consumer space. 2B business is harder.
Okay.
Especially in an area where product innovation dominates. Because do we really know what's the next blockbuster drug here? Do we really know what's the next smart way of doing these large language models? You know, I mean, that's really at play. But for the companies with a large customer base, they can always sell through their new innovations or take some from somewhere else and sell through their customer base.
That's a good point.
I think that's easier to look at, you know, to figure it out. Yeah.
To monetize the customer base.
Yes.
In terms of the risks next year, what are some of the things that you're focusing on for 2026, Michael?
I think on everybody's mind is AI. You know, I think this is circular financing come to an end, in my opinion. My humble opinion, that could be too early. But the cowboy mentality, just spending, you know, increasing scales, I think that's behind us. Really, people want everything, right? Okay, you have a huge capex, fine. But where's the margin? Where's the return? Where's the subscriber growth? I mean, if you, under those lights, I think very few companies probably can make investor happy.
Okay.
Right.
One last question here. Sure. We've been asking our guests, and you've set it up perfectly. In the scenario that U.S. mega cap corrects next year, right? So if someone disappoints on capex and everything else starts, you know, multiples start narrowing and coming back down, where does it leave Chinese markets? What do you think the correlation is between this cohort and that cohort?
Very strong correlation.
Okay.
I cannot escape if there's something happens in the U.S.
Okay.
Okay. Michael,
right.
it's great to have you. Michael Liang, we'll see you next year, Chief Investment Officer at Foundation Asset Management Hong Kong. We'll bring you some live pictures that we're seeing here. Of course, with Premier Li Qiang there is meeting in the 1+10 dialogue in Beijing. So this is kind of the multilaterals, as Dave mentioned earlier, the 10 economic international organizations, including the likes of the New Development Bank, the President of the World Bank, Ajay Banga, Kristalina Georgieva, the MD of the IMF, also when it comes to the WTO and the like. So obviously there's going to be a lot of talk there. You see Andrew Bailey there. He's actually chair of the Financial Stability Board. That's what he's representing here today, not the BOE. But yes, we'll have give you more updates once we hear from, of course, this meeting. This is Bloomberg. All right, continue to focus on, of course, the consumption space as well. And car sales in China actually fell for a second straight month in November as discounts failed to make up for the end of a trade-in subsidy. Let's get more now with our team, our Asia transfer reporter Linda Liu, and also our Bloomberg intelligence analyst Joanna Chen with more analysis. Linda, I'll start with you. So another bad month. What do we know and what we learned?
Yeah, this is especially concerning because the last quarter of the year is usually the busiest, one of the busiest sales period, because this is when car makers really make the final push to reach their annual sales target. The fact that November actually, car sales actually fell 8% is quite concerning, and you even have industry bodies essentially saying this is quite rare. So this just really adds to a lot of the headwinds that Chinese car makers are facing right now.
And let me bring in, before we talk about the survey, just your thoughts on how the year's been and why are we seeing this current soft spot going into what seasonally should be a good month, as Linda was pointing out.
Yes, it's actually a lot of policy volatilities here. So the first half of this year is really supercharged by the trading policies, by the central and local governments. And as we approach November, I mean, the subsidies are starting to run dry, and then many local governments are already wrapping up their subsidies. So that's why we see this soft spot in auto sales, and it's actually all eyes on 2026. We still don't know if China is going to extend the trade-in subsidies. We are thinking very likely, but details of the policies are still lacking.
Yeah, you mentioned about gradually phasing out these subsidies, right? What is the implication for 2026 and beyond And is it really going to hurt in any way EV adoption in China?
So 2026, we are definitely seeing slower sector growth. First is subsidy cuts, and also it's like higher base effects, getting higher every year. So the growth rate is going to slow down, but adoption rates, we are seeing that EVs are still getting market share higher every year and at the expense of gasoline cars. And how China plays it is like they gradually phasing out trade, subsidies and tax incentives for EVs. So those less competitive automakers, they stop getting funds, and that let the industry consolidate. And in terms actually China will be pulling more subsidies into the charging infrastructure for a healthier long-term growth of the sector.
What are you hearing around subsidies next year? Not so much from the government side, but as far as what the players and OEMs are starting to prepare for strategically going into next year?
The industry bodies definitely are urging the government to consider renewing the trade-in subsidies. They point to, China is facing a weakening economy that's really weighed on consumer sentiment. So the trade-in subsidy has been a big boost in demand, considering now China is cracking down on this price war. So there's actually not a lot of space for the manufacturers to keep discounting. So the subsidy is going to play even a bigger role coming into next year. So I would say the entire industry, from manufacturers to bodies that advocate for them, they are really hoping for another extension.
Yeah, and it comes down to maybe technology too, Joanna. How do you see maybe this change in the industry landscape when you have things like autonomous driving, for example? How is it changing things, and who has the more competitive edge now?
I mean, all those smart technology is super important in China now, and Chinese consumers actually rank it as number one reason why they choose a battery electric vehicle instead of like a traditional gasoline car. So in that space, we're seeing the automakers' reputation actually diverge. According to our BI survey, that about half of the respondents saying that they would only use autonomous driving if it's provided by an EV pure play or the tech firms like Huawei, Xiaomi, this kind of stuff. And only 10% of them saying that they're trusting those technologies from legacy Japanese and German auto brands. So you are definitely saying that this smart tech is reshaping automakers' reputation, brand images, and where if you win on the smart technology front, then usually you get a greater competitive edge.
Yeah, I think there we go in terms of just brand preference.
Yeah. You see there.
What did you buy, Yvonne? No. No, but to the point that Joanna was just making, right? So it's further down the list. You have what used to be when we were growing up, the cars of choice, right?
Yeah.
But now it's really you got to show me the tech,
Show
and
me the
then
tech.
prove to me you're a car.
Show
right?
me the cool
So,
gadgets.
Yeah.
Yeah, all the like there. Great survey. Thank you so much,
Fantastic.
of course. And our thanks to Linda Liu, our Asia Transfer reporter, and Joanna Chen there, our Bloomberg Intelligence analyst as well. We've also have switched to EVs.
Yeah?
7-seater Chinese brand. I'll let you guess.
They're really...
They're great.
They're fancy, right?
Gosh.
I am actually...
My favorite feature is the fridge.
One? There's a fridge.
There's a fridge.
Well,
and you can adjust hot and cold.
Okay, well, Yvonne's she needs her latte, and every now and then she needs the bubbly
More for
chill.
groceries.
Sorry, okay. More for pak soy. Okay, all right. Plenty more ahead. We'll leave it to look at markets. Down half of 1%. Tech dragging today, but not by a lot.
In some world news this morning, a powerful magnitude 7.5 earthquake struck last night off of Japan's northeast coast. Authorities have lifted all tsunami warnings for the prefectures of Aomori, Hokkaido, and Iwate. Japanese Prime Minister Sanae Takaichi says 30 people have been reported injured, but we've had no reports of significant impact on infrastructure or nuclear power stations. Ukraine and its European allies say they're increasingly confident of reaching a deal to use frozen Russian assets following talks in London. The UK Prime Minister's office says the discussions made positive progress on funding as the U.S. winds back aid to Ukraine. But Ukrainian President Volodymyr Zelensky told Bloomberg before that London meeting that territorial and security issues require further discussion. President Trump has signaled he could impose fresh tariffs on agricultural products, including Canadian fertilizer and Indian rice. It's the latest sign that protracted negotiations with two U.S. trading partners could drag on even longer. Two separate U.S. delegations are in New Delhi this week for talks, but officials say they don't expect any immediate announcement of a trade deal.
Right. Just a few pockets of movers we're looking at. Chow Tai Fook, this is a Jefferies call and a cut on the call they're coming out of the brokerage. Weak sales outlook, we're down about 1% on that. The consumer retail sales have been weak despite gold and jewelry sales outperforming so far. But that's the note coming out of Jefferies. Let's move things along. Have a look at biotech. So this is a JPMorgan call. Deeper cuts on prices as far as the latest drug reimbursement list is concerned. But while that may be the case, don't expect proportionate downside in some of these names as well coming out of JPMorgan. So not as bad. Right. The opposite side of this is copper. And when you look at copper prices, whether that's the LME or the contract in Shanghai, which is the one, the LME contract's bottom of the screens, we're looking at declines there, despite the fact that we are at records. Although that being said, the copper price itself, 14-week RSI, is at highest since, I think, May of last year. So this has really been a massive standout in the commodity space in the last few weeks or so. Okay, that's a look at some of the movers right now. We have lots more on the way here on the China Show. We'll have a look at broad markets. We'll recap some of the big stories like the Nvidia China story. We are in the window for credit numbers coming through out of China. Equity markets are flat this morning. Plenty more ahead. This is the China Show.
Welcome back to the China Show. And look at the HSI half hour of the session, and it is looking pretty quiet out there. We're just down by about a third of 1%. Of course, we're waiting for the Fed. Obviously, there's that Nvidia story that is kind of giving some pressure to some of these Chinese chip makers in China here today. But other than that, not a whole lot of conviction here as we count down to, of course, the end of 2025.
Yeah, after all I'm going to hit you with a big word now, the vicissitudes of the market this year. Yeah, it's a period of calm and quite frankly boringness going into the end of this year so far. Half of 1% to the downside, that really doesn't tell you a lot about where this market's been. And also when you look underneath the hood, the range of the movers really doesn't tell you a lot. It's very tight on individual names as well, with the exception of like SK Hynix, which is an example. We'll talk about that later, of course, and the warnings coming through from the exchange itself on the stock. Okay, that's a benchmark story, which is really a nothing burger story. Chip story coming up. I think we're looking at declines there among some of the Chinese chips. That takes us maybe into the Nvidia story. Some declines, not a lot.
Yeah, some have turned positive as you spoke.
Yeah, the More Threads one. How much did it do on Friday?
400%?
430%.
Bell's here. Yeah.
Top of 502%.
Okay. On that note, let's bring in Annabelle Julius, of course, here with us on set. If she hasn't made her presence felt already on the chip story, but the big one we woke up to this morning was the headline that Nvidia will now be allowed to sell chips to China. What do we know?
We know, well, that's exactly what we know, that the Trump administration, after really weeks of deliberations and consultations, lobbying efforts from Nvidia as well, has decided to greenlight Nvidia to sell these chips to China. Now, the H200 is a chip that was actually only being sold to US companies and others as late as last year. So it really is not too far behind where we are today, which is Blackwell architecture, and then we go into Rubin architecture next year. But the H200 chip, rather, is significantly more advanced than China's been able to access before, which was the H20, which was designed specifically for the mainland market. H200 was a broader chip. It's one that's got very strong inference capabilities. And as we were discussing in the last hour, you need chips that are designed or strong in training for building up the foundation models. Inference is how you actually start to deploy that technology. So as businesses start to use AI technologies, you really need those inference capabilities. So the H200 is perfectly suited for this process. So that is what they've been allowed to do. We've got the take from our team at our geoeconomics team, and they're saying that this is really the biggest pivot we've seen from the Trump administration ever, really, when it comes to China's access to this technology, just given how sophisticated the technology is. But at the same time, it still comes back to that key question, how does China respond to this? We know from the True Social post that President Trump said he'd informed President Xi and that President Xi had responded positively. But what does it actually mean in terms of the willingness of Beijing to allow Chinese companies to say, yeah, we want these?
Yeah, I mean, you mentioned it's significantly more advanced than the H20, but there is that rhetoric from the Beijing side to maybe not use foreign chips, right, in their whole sort of AI development. So where does that tell you in terms of China's AI trajectory moving forward?
I think it depends. I mean, it depends on where they want to go and how they actually want to. Do they actually want to use H200? We don't know that just yet. We know that Nvidia has completely taken China out of any of their forward guidance calculations. In the latest earnings, we saw they'd removed any chance of China revenue. It is, of course, it's a multi-billion-dollar opportunity. China does face a shortfall. You've got Huawei, for instance, that has the Ascend chip series that has been making inroads, and they're saying that, again, this has some strong inference capabilities, maybe not at the level of Nvidia, but you're still trying to catch up. Yeah. But at the same time, Nvidia and the foundries, Huawei, SMIC, can only produce so much. And that has been sort of one of the key constraints, is just the ability to meet the demand in the market, even though you've got these players that are, again, producing less sophisticated technology than Nvidia, but still chip technology. And you've seen that from more threads, of course, it's, making fully functional GPUs, but you've got the likes of Cambricon as well, another well-known chip developer in China. So the ecosystem is growing, but I think, again, it comes back to that key question, where does it actually land with Beijing, and what do they want, and how do they assess their capabilities? And I guess it's a trade-off. If you take the H200 chip from China, does that in any way stymie your efforts to also build up your self-sufficiency?
Well, speaking of, President Trump also chiming in, signiling he wants to do away with state-sponsored?
State-based rules.
State-based rules around AI.
State-based rules for AI, which is, I guess, not surprising in some ways. That the way that AI rules were shaping up in the US was actually starting to get quite convoluted and complex, because they were regulating on a state-based level. And that is quite challenging for tech companies that face rules in one state but different set of rules in another state. And so the question or the complaint from big tech has been is that you're going to slow us down if we have to try and meet all of these different rules. President Trump has been on True Social, and he's saying that moving forward they just want to have one rule book, and he's going to be issuing an executive order this week. So we do want to get details on exactly what that rule book would look like. Of course, we've seen a draft of it already, but hopefully get more details. And again, it comes back to that key question of competition, because what big tech is saying is that you can't over-regulate us, you can't regulate us in too many different ways, because you just slow down our ability. You slow down our ability, it also impacts our ability to compete with China.
Well, thank you. Our Asia Tech correspondent, Annabelle Drewler's there. Another big story, of course, we've been tracking is this readout from that December Politburo meeting, which we were looking for maybe any signs of what the policy outlook is going to look like for 2026. And I think some have basically said pretty muted response, I guess, from now, and somewhat disappointing. In particular, because I think the tone was quite upbeat, right? There was that lack of concern in terms of the growth side of things, where we have seen actually growth slow down quite a bit in the fourth quarter. And then what was not mentioned, right? This deterioration in the property sector. No mention of anti-involution either as well. This campaign, which some have said is maybe that's why we're seeing investment in CapEx really kind of drop off significantly as well. No mention of that. What does that tell you about where things go on that too?
Yeah, well, against the backdrop of cyclically, the data has actually started to become soft recently, with the exception of exports, which actually have held up. And that might be one of the sort of bright spots and tailwinds perhaps, but it's also we're in between processes, right? So there's the Politburo meeting, which sets the tone for the Economic Work Conference, and might we get more details there, because then they work out the blueprint of what the March meeting is going to look like.
With growth targets, budget,
and everything else. But yeah, I mean, you simply look at bond market reaction so far, it's actually gone the opposite way. Bond futures actually fell, I think, going into today. We're seeing a bit of a bounce, but you take a step back, bond futures are actually down the lowest level in the year. So actually yield should be picking up a little bit further. Is that telling us that somehow the inflation story will take care of itself, and the bond markets actually see some inflation down the road, which is not too worrying for policymakers? The other thing, too, which is not mentioned, but I think is part of it, is when you look at the subtle shift in the currency and that leaning into leaning against the strength, because they had been leaning into strength, right? And how that goes into economic policy for next year. More proactive, but it's really more of the same. And I think the Goldman line actually underscores the point that they were somewhat disappointed, but it doesn't obviously point to the lack of support. It was just a lack of new support. At least we haven't heard it in this point so far.
Compared to the last readout, I think they talked about stabilizing the property market and the stock market.
Yes.
Seems like they've achieved at least the latter one. But no mention this time in terms of the housing sector. I think that was where the disappointment lies. Also, you mentioned about the fact that, when it comes to no mention of anti-involution, maybe the whole, concerns around overcapacity, like maybe are not as entrenched as we thought it was. That was according to what some economists had thought in terms of the signals sent on that front as well. But then again, we'll see, right? So that's really what the readout is and what people are interpreting here so far. But yeah, the market reaction has been pretty muted, to say the least.
Okay. Yeah. So, in fact, later on, I believe our folks at Bloomberg Economics are coming on as well to help us unpack that story, the outlook for next year. Maybe the currency, we'll talk more about that. But before we get to currencies, we'll talk rates and everything fixed income. JPMorgan Asset joins us in a couple of minutes to talk us through their latest quarterly review and really what's been a year where high yield has done exceptionally well compared to most other peers in the fixed income space. Julio Callegari joins us in a couple of minutes. This is Bloomberg. Right, welcome back. A glance at currencies. We have an RBA decision in about, there we go, an hour, 19 minutes, and 7 seconds. There we go. No change expected for today. In fact, no change, I think, for 3 meetings now. But you look further out in terms of pricing, you know what? A hike's actually slightly being priced as the next move. We'll see what happens with that. Of course, there's been a fairly hot inflation print, the most recent one out of the RBA. When you look at the BOJ, obviously that's a rate hike, if and when. I think Citi joined us yesterday, and they think it's going to be a hike. It's going to be a hike before the end of the year. It's going to be a hike again in a 6-month increment until they get to 1.5%. So, hikes are suddenly part of the vocabulary these days. Now, all that is to say, there's also a Fed that's going the opposite way this week, and how low they go is actually still up for debate. Our next guest actually sees support for global bond markets continuing into 2026. You have a lot of calm restored. As you can see, performance across high yield, treasuries, investment grade have all done well. High yield has obviously done better than others. Let's bring in Julio Callegari, Asia Fixed Income CIO at JPMorgan Asset Management. Very nice to see you. Good morning.
Good morning. Thank you for having me.
So calm has been restored, and geopolitics has also started to behave itself. Inflation seems to be settling higher, but settling, I think, is the proper word for now. What does it mean for the investment environment next year?
I think it's relatively benign because this is an environment in which, on the back of a relatively soft labor market in the U.S., the Fed may cut a couple of times, in our view. At the same time in which, for the rest of emerging markets, for example, the cuts are largely done. We are talking more about pause. You just mentioned RBA, right? And now, if anything, the market is starting to price the odds of a hike next year. This is also true for New Zealand, to some extent to South Korea. So I think this is an environment in which we see Fed cutting, most of the other central banks pausing or thinking about hiking. And this will, in our view, reinforce a bit of this dollar weakness, which tends to be relatively good for the rest of the world.
Should I expect then longer-term yields globally to remain quite sticky then?
Yes, because even though we see, the Fed cutting a couple of times, inflation is still relatively sticky as well. And this is an environment that probably we are not going to see a lot of cuts. And if the rates are sort of range trading, the market will keep bias for some sort of carry investment profile. But if the dollar is getting slightly weaker, where we see a big opportunities in Asia FX, because Asia FX never participated in the rally that we saw in 2025. So if the market ended up delivering what is priced now, meaning Fed cuts and no cuts elsewhere, we think this is an environment that probably will favor, the local space in Asia.
How do we need to look at the risk of inflation? And I call it the risk, not so much because we haven't really seen it. The risk of inflation reaccelerating because, these economies have yet to feel the full extent of the lag in monetary policy. We've been easing all of this year, and then you have the likelihood of more fiscal stimulus coming next year. Isn't that a recipe for likely more inflation than the opposite?
Right. Well, in Asia in particular, we are quite comfortable.
Okay.
Reason being, well, we never had tariffs, right? Second is, if anything, China is still exporting some disinflation, right? And the third element is the starting point is relatively low. Inflation has always been relatively low in Asia. So particularly here, I don't think we should be really concerned about a big spike in inflation.
We were just talking about the outperformance of this year, whether it was high yield. I think EM debt, for example, have really kind of, in some ways, surpassed the outperformance that we've seen in treasuries. Is that likely to be the case? I mean, what's the strategy for next year now?
Yeah, we think that there's still room to have, again, outperformance, in the dollar space, in EM, and Asia high yield in particular. So why? First of all, we still see some premium versus DM, particularly in the high yield space, both in EM high yield in general, but also in Asia high yield. You still have something like 60, 70 bips of premium, even when you exclude the China real estate, which is the most controversial one. You still have some premium. And we think that the environment is relatively benign in terms of growth. So if this is sort of carry in the high yield space continues, we think that we're going to see the third year of outperformance of Asia high yield versus DM. And in emerging markets in general, even though it's true that spreads are tight, but they are tight for good reasons. Fundamentally, there was an improvement in terms of, let's say, the debt to GDP versus DM. Most countries now have a proper inflation targeting regime. Inflation is better anchored, etc. So we think that, and the supply has been relatively limited. So I think this combination will probably sustain another outperformance.
Yeah, and I know we ask you this question every time on supply. Almost in a 6-month cadence basis that we talk to you, do you see any new signs that supply is perhaps the supply story is going to change?
Well, we don't think it's going to change much on a relative basis. More DM story supply.
Okay.
Yeah.
Now, help us understand that as you look into, steepeners have done very well this year. Is there anything to expect that doesn't continue next year?
Well, I think that the risk here is, as a baseline, the steepener should still be okay. Right? Because if the Fed is cutting with the economy okay, and there is more supply of that in U.S., it's kind of expected that we could see additional steepening. The risk is, what if, we see some sort of new round of U.S. exceptionalism and growth is way stronger than people thought, right? And then in the end, the Fed does not deliver the cuts that the market is pricing in. So in that sort of environment, we could see a damage to the steepening trade.
I was going to get your take on you mentioned the BOJ that might be ready to, I guess, start this rate hiking cycle. We started to see more foreign investors really storming into this market in some way. What sort of impact do you think this could have?
Right. Well, it's definitely, the trend seems to be for some normalization, right, from the BOJ perspective, which, if it's happening simultaneously with the Fed cut, definitely one key difference is that rate differential that was always so in favor of shorting the Japanese yen, because the rates differential was so against Japan. Now we are finally seeing a substantial normalization. If you look at the very long end of the Japanese yield curve, right, the 30-year is already paying 3.5%. So it's becoming juicy, actually. If you buy the Japanese yen and you convert it back into dollars, you ended up gaining more than treasuries. So on the back of this normalization, we think that it's possible that we finally see the yen, proving to be, performing better or stronger versus recent years. And we think that this is one of the anchors in the Asia FX, is the Japanese yen and also the Chinese renminbi holding up better than before.
Maybe one last question on Japan, because it's, the example I can think of with, positive real rates returning in Japan is almost akin to when China entered the WTO from an economic basis, right? It's almost like you have this massive new factor to consider that people were not used to. I can't remember the last time Japan had a positive real interest rate and the Fed was cutting, let alone those two together.
Right.
Longer term implications for you. When you look at longer term strategy, what does that mean for guys like you in the business long term?
Right. So one, I think that what's potentially really big happening in the region, if we continue to see this path, is much less, investment from Asia necessarily going into the rest of the world, and particularly U.S. Just to give you one number that I think is quite impressive. Over the last 12 months, if you take the 5 biggest current account surplus in the region, there was a surplus of $1.3 trillion only in 12 months, right? If all this money that typically has been flowing to the DM and US in particular is just going less. So I think the importance of this is not that you need a lot of repatriation, right? It's not that you need a lot of selling, let's say, US S&P.
Just less departures.
Is less departures. You can have a meaningful impact in terms of flows staying in Asia. I think this is something that could be relatively new because it has been happening for so long that people even forgot about this possibility.
Asia exceptionalism, let's call it that.
Sort of.
Julio, on that note, thank you. Julio Callegari there, CIO of Asia Fixed Income at JPMorgan Asset Management. Look how Asian markets are doing as we get to this break here as well. We talked about how quiet is, and looking at onshore, we are seeing Shenzhen still doing very well right now. Chinex is up 0.8%, really bucking the trend here this morning. This is Bloomberg.
All right, welcome back. I think something's done well. And no, it hasn't been gold of late. It's been silver, though, if you look at precious metals. But within the commodity space, the story's been silver, and it's been this. 33% year to date, and that acceleration and that steepening of the slope rightmost side of your screen just underscores the story of late. It's not just this. You look at the copper price in Shanghai has also done a similar dance to the upside there. You had the politburo sets. That's the China story. The angle here, domestic growth, the top economic priority next year, despite, of course, some of the comments coming through out of the analyst side of things. You have stockpiling of the metal in the U.S. You have the looming tariff conversation perhaps as more of the risk, but you look at the biggest mines in the world, and it's easy to understand why folks aren't too excited over a looming supply of an avalanche of supply coming through. To put everything together for us, Martin Ritchie is in Shanghai, our metals and mining reporter. Risking asking you the obvious, Martin, why is copper doing what it's doing?
I'll just focus on one aspect of it. You mentioned China and the Politburo statements yesterday, but I think and that's part of it. But what I think the major driver of copper at the moment, and over the last few weeks during this very powerful rally, it's expectations that next year President Trump may put tariffs on refined copper, the most widely traded form of the metal. And traders from Asia, from Latin America, are rushing copper to the US. Before that happens, prices of futures in the US are still at a premium to the rest of the world, so they can make money by getting as much copper to the US, stockpiling it there as possible. And this is potentially leaving the rest of the world a bit short. And that kind of narrative is what's been driving the price over the past few weeks, and we've seen a lot of bullish calls emerge as well in recent months. Mercuria, which is now a major force in copper trading, say they see 500,000 tons going to the US next quarter, and we had Citigroup with a call for 13,000 a ton by the second quarter next year. That's versus just under sort of 12K at the moment. So there is a lot of bullish noise around at present because of this US tariff trade.
Yeah, certainly. You add that with, of course, the EV space, the new demand for data centers, given this whole AI wave as well. Certainly, that's why we're seeing this kind of shortage there quite pronounced. Martin, thank you, our metals and mining reporter, on what's really kind of driving these copper prices this morning. May not be so much the China story, more about the stockpiling story, right, in the U.S. Here's what we're looking at in terms of course, MCC shares, something the most on record on this sort of asset sale plan here. So we're down close to 10% here right now. Ascletis, that's also what we're watching out for in the biotech space as well. So those shares jumping after this study did show something about weight loss there on your screens. This is Bloomberg. 11:29 a.m. in Tokyo. Japanese markets heading at lunch break in just a moment. And yeah, we're awaiting, of course, that 5-year bond auction that's happening in Japan any moment now. But yes, it's a pretty quiet day all around the region here this morning, with the Nikkei just higher by about 1/5%. We're flat when it comes to the yen at just 155 levels as well. But yeah, key to watch, of course, as we see this kind of global yields kind of picking up around the world. That certainly is one thing to watch here around the BOJ, which does meet a few more days.
Yes, but we had to get through the RBA in about an hour
and
or so, and then the Fed, and then I think the one story that people are sleeping on is the Philippines, because that seems to be the market, or the central bank specifically, that will, not just because I'm Filipino,
bias.
the bias there, home bias of David. No, just because that seems to be the central bank that has the strongest case to cut not just once but more.
Oh, yes.
Yeah, when you look at what some of these calls are saying. Right. That's just also to say it's a very quiet day in markets. So if you need almost a general aesthetic, this is really a market that might put you to sleep quite quickly.
We're here to wake you up. Come on.
Okay. So let's talk about the outlook then in terms of the Chinese economy.
Yeah.
Right. So you have Bloomberg Economics. They think that the guidance coming through out of the Politburo meeting indicates continued stimulus into next year, at least matching expectations and the support that we've gotten so far this year. David Chu, our economist with Bloomberg Economics, joins us right now to give us their first reaction, of course, to the Politburo meeting ahead of the Central Economic Work Conference. David, good morning. Nice to have you. Yes, sir. What's the prognosis?
Hi, morning. Actually, I think the statement of the Politburo meeting yesterday was kind of plain, because it covers everything, but the wording was broad and general. But all in all, it released a signal that the stimulus or the support from the policy side to the economy is going to continue in next year, because the Politburo emphasized to do some counter-cyclical thing and to continue to do the proactive fiscal and monetary policies. So all in all speaking, we think that this year's stance will extend to next year.
There was this term that came back New productive forces, David. We haven't heard that phrase, I think, since 2023 or so. What does that tell you about how policymakers are looking at still exports and manufacturing?
If you are in China, you would understand that why this world is so preferred, so loved by the leaders, because China has been doing actually working on the so-called high quality or something like that over the past several years, and it seems that this works, especially when China was facing the headwind from the trading sector in this year, so that the leaders will believe that continue to work on this area will continue to benefit the economy and also the corporates. So if you look at the trade side, we think that in this year, in 2025, the overall export sector has been resilient, which can be seen from the exporting numbers. But for next year, we see despite of the truce between China and the U.S. for a year, we still see some headwinds. One of them is the pullback of the export, because in this year, the importers in the U.S. they were rushing to buy things from China because of the uncertainty of the tariff. But for next year, we think that this kind of thing will roll back, so that we see that is a technical reason for the export. And on the other hand, we see that more and more potential trade tensions may come up because, for example, you see what Macron said over last week, that China is needed to adjust the trading sector to reduce the trade surplus.
David, a few things, right? So we have the Central Economic Work Conference, number one. We still have yet to see the credit data, which I think we are in the window for from today, activity numbers, and then let alone, of course, the March meeting where we get the targets as well. Looking at the direction of the data, do you empathize with the lack of urgency? In other words, the lack of urgency doesn't necessarily mean we need to be worried over it. Do you see the case to be just quite chill about things?
You mean next year?
Well, now going into next year, the momentum in the economy going into next year.
Yeah, I think the most important thing is still consumption, because if you look at if you go through what we cite here, we expect a headwind to the export, and also another background is that the investment in China has been slowing down, especially the government-led investment. Maybe it has dropped by 7 or 8% over the past several months, year on year. So that looking at the next year and then the foreseeable future, we think that both the export and investment should remain sluggish or face a headwind. That means the consumption or domestic demand will be the key for the development or growth for the next couple of years. And that is why I think the Politburo meeting emphasized prioritized the domestic demand as the key issue for next year. And actually, within the domestic demand, I think consumption is the key, because this is something we need to address. But of course, it may need to take several years to solve this problem. But anyway, we need to start to do this from now on.
We do. David, thank you. David Chu there, our Bloomberg economist, on, of course, what to look out for Chinese growth for next year. Certainly when it comes to boosting domestic demand, that's certainly one factor in all this is where the renminbi goes, right? Because we just had an economist just last week talking about the need for policymakers to keep that renminbi strong in some ways, to boost imports, to boost consumption in some ways, and have people spending more. That certainly has been a key focus when it comes to the currency of late here. Here are some of the guests on the China Show and what they've been saying.
we actually think dollar CNY could go to 7. We actually think, we're expecting, we've got trade data coming out today. We're expecting a bit of rebound. Look, China's exports are still super competitive. We've had statements coming out of Macron saying they might have to do tariffs on, trade deficit, the trade imbalances. So I think in order for China to appease some of its trading partners, given that renminbi on real effective exchange rate has already depreciated a lot, they probably will be willing to give a little bit more slightly stronger bias on fixings and maybe allow a little bit of strength to appease trading partners.
All in all, I'm saying is exchange rate should be determined by market forces. And then all these three market forces, whether it's fundamentals or interest rate or it's the positions, capital flows, they just, maybe towards the year end, they just amplify and combine each other. That's make it a good timing to let market decide.
RMB has stabilized and with modest appreciation bias, we forecast RMB to stay at 6.95 over a 12-month horizon, and that has been supportive usually for MSCI China over the past decade or so. Secondly, when we focus on the fundamentals, we see some signs of earnings stabilization. For the offshore market, we've seen some of the earnings revision momentum has stabilized.
The RMB, from a valuation perspective and competitive perspective, you look at China's exports, and even especially if you do product by product, it is extremely competitive. It is on the low end of valuation. We've seen a very long stretch of real RMB depreciation, the longest one actually since the 1990s, or actually the largest one in terms of magnitude since the 1990s. Extremely competitive. We're just looking for a catalyst.
Right. Well, to further the discussion on the direction of the currency short and longer term, a deep dive, if you will, on the outlook for the Chinese yuan, let's bring in our team here. Stephen Chu, our Chief Asia FX and Rate Strategist, here on set with us. He's out of Bloomberg Intelligence. And joining us also is Dan Moss. Daniel Moss, Bloomberg Opinion columnist, also joining us to help us understand what's going on. Dan, you're making the job super easy for Yvonne and myself. The title of your piece today, why the push for a stronger currency won't go away. So I'm just going to add a question mark there and ask you that question, Dan.
Well, David, I mean, the inspiration for the column came in part from listening to the litany of guests that you've had on your show, some of which you just replayed clips of. There does seem to be a drumbeat that suggests it would be a good thing for the Chinese authorities to be a little less constraining regards the yuan. There appears to be a lot of pressure building. The morning fixing suggests that. Bloomberg economics models suggest that. A lot of pressure for the yuan to strengthen. And we had these trade numbers yesterday, which, blew estimates out of the water. We've got a $1 trillion US surplus cumulatively for the first 11 months of the year. There is no sense that the RMB's value is holding exports back. In fact, China is as much an export machine now as it was at any point, certainly since WTO membership, and if not prior to that. The arguments are just piling up. The authorities seem keen not to allow too much of that. But these forces are not going away.
Stephen, I'll get you to chime in. I mean, do you think now is the time to let the renminbi strengthen a little bit?
Absolutely. I mean, if you ask me for next year, it's our favorite currency within Asia. Regardless of whether we have a strong dollar or weak dollar, as the guest said, all the tailwinds basically just line up. Structural, we know about the trade balance, we don't have to talk about it. Now, on a 12-month basis, we're at a record high, over $1 trillion. It's still, impressive. And then FDI used to be a headwind for the yuan a few years back. Now the flows are coming back in again. Again, a strong yuan. And then from a rate gap perspective, the Fed is cutting. Regardless, next year, we may have a very moderate cut, still lower US rates. But for China, they have less urgency to cut rates. So from a rate gap perspective, from a market driver perspective, it helps the yuan. And last but not least, we saw from the Central Politburo yesterday, they highlight this cross-cyclical term, meaning that they're focused more on the medium term, so it's more fiscal, less of a rate cut perspective. More importantly, they want to drive domestic demand. They want to globalize the yuan, and a weak currency is just against that.
What have you noticed, Stephen, on the recent pattern of fixings? Because we've seen stronger, and then they push back 1 or 2 days. What do you think they're signaling to the market?
I think it makes sense. They want to slow the yuan game for a little bit because, to be honest, now the spot and the fixing is has sort of converged. And our fair value model suggests that now we are at fair value for dollar yuan. So I think it makes sense for them to stop a little bit because obviously 7 is the key level. If it breaks, then the acceleration in the yuan appreciation will accelerate. So they want to stop it here. Okay, let's wait. Let's wait for the Fed. Let's wait for the BOJ, and then enter next year. It's still going to crack 7. It's a matter of time.
Dan, you mentioned about you don't have to really focus on what a stronger renminbi could have on exports. It's already an export machine, China is. What about when it comes to trying to get out of this deflationary sort of cycle, right? It seems like if you're going to strengthen the currency, that could actually lead to some complications on that front.
Yes, it could lead to some complications, Vonnie, and that may explain some of the reticence. You know, many of the guests that you've had on the show recently, talk about the need for China to bolster consumption at home. It's funny, this is a year of anniversaries for the Chinese yuan. 2005, years ago, the hard dollar peg of 8.3 was severed. And then 10 years ago, in late November 2015, the IMF granted the RMB reserve status, ushered into the inner sanctum. But one of the requirements of that, and one of the bets that the IMF made, was that the RMB would become more globalized and would become more flexible. It's debatable the degree to which these things have happened. So China does have a deflation problem for sure. This is an inflation problem that, it's way too low. So they want to or stimulate more domestic demand. Partly you do that through a weaker currency. It is going to exacerbate some of these deflationary forces. But, it's worth just... We've been talking about this rebalancing of China's economy for decades now. For such a long time, no IMF or G7 or G20 communique was replete without a reference to rebalancing. It's perceived to be in everyone's interests, no more so than now. But yes, it's complicated, as they say.
Yeah, and Dan, just a final question for you. I mean, continue the last point you just made, China will do what is in its interest, really. And so we talked about 3 factors, right? Fundamentals of the economy, interest rates, monetary policy, and positioning in the market. There's a 4th factor, global politics. And do you think a stronger currency actually allows a more stable environment going into next year?
It's interesting. During Donald Trump's first term, he was on about countries, including China, keeping their exchange rates weak to, quote unquote, rip off America. Now, what we haven't heard as much of in the last 6 to 9 months has been US complaints about the level of the Chinese currency. Now, that doesn't have to be static. This seems to be on a slower burn than, say, soybeans, access to chips, et cetera, et cetera. Chinese leaders would probably want to keep it that way, and the way to keep the currency off the radar screen is give just a little bit more. Now, it has appreciated this year, but the gains have been pretty middling compared with, say, the Thai baht, the Malaysian ringgit, the Singapore dollar, the Taiwan dollar. They can do a little more here, and it's not going to hurt them.
All right, Dan, thank you. Dan Moss there, Bloomberg opinion columnist. Also, our thanks to Stephen Chu there joining us from Bloomberg Intelligence. Yeah, 7 or even sub 7. That certainly is the call from many for next year for dollar China. In terms of what to watch out for, of course, you can read more about the red discussion on the terminal. We have an article that talks all about it from an ex-PBOC advisor today on how China should raise imports to promote the currency. This is Bloomberg. All right, we're checking on the chips. Yeah, chips are coming off the table here today. We take a look at what we're seeing regionally. SMIC, Capricorn was initially a bit lower. We've climbed back a little bit, but SK Hynix also given that warning from the Korean Exchange this morning as well. Obviously there's been a lot of talk about this whole Nvidia and President Trump giving the company at least that approval to sell its H200 exports to China as well. That might actually hurt some of the Chinese names. That certainly is the key focus here today. But when it comes to global fund managers, well, what does that mean for nuclear, right? Because this year's rally in some of these nuclear stocks, they say will continue as the regulatory outlook improves and, of course, demand drivers extend beyond the needs of AI. Let's get to our Asia equities reporter, Sami Cha. She's with us here right now on, what beyond just the AI story, what's really driving these stocks, you think?
Yeah, so after being handled with caution for decades, it's suddenly being called the utmost priority right now in artificial intelligence race. And we look at the Bloomberg gauge of nuclear stocks, it's rallied 38% this year, adding $566 billion in market value for all of these stocks. We take a look at some of the individual stocks. Oklo, this is a California-based reactor builder. It's up about 400% this year alone. Doosan Enerbility is up 330%. That's an equipment maker for this nuclear reactors and so on. So all of this, again, it's because of that projection that we need more energy, and it's going to triple in the next 10 years. But there's another driver, which is the regulatory change. So Japan is restarting nuclear reactors, and Taiwan is mulling to do the same. But there are some game changers, like in the UK, they're actually allowing, or they're thinking of allowing these nuclear projects to qualify as green financing. So that means, the ESG funds are going to come in. So this is going to be like a big pivot for the stocks. But valuation is really tricky. Doosan Enerbility is trading at over 100 times earnings now.
Well, speaking of something that's gone up very much to the point where it's getting warnings, SK Hynix, how does that work? Because we're getting a warning from the exchange itself on the stock. So what does that mean? And just give context there.
Right. So we saw a similar warning. It was actually the same warning earlier in November. So this is the second time already. And we've seen that a lot. But mainly the reason this time was because it rallied close to 6% on Monday because of this speculation that the company is going to issue American depository receipts. And so the company did say that they cannot. Nothing is decided at the moment. But of course, this would, if it does issue ADR, that would actually really help narrow that valuation gap with Micron technology. So that's what analysts are saying. And that's why a lot of investors are just piling in.
Yeah, it's a slow day in terms of markets, but you're focusing on key sectors. Brokerages, certainly in China, are one. Why brokerages? I mean, we did hear a little bit from the CSRC, Wu Qing, speaking over the weekend, too.
Exactly. So CSRC chairman said that China wants to create large and powerful investment banks by the likes of Goldman Sachs and JPMorgan, through these M&A processes. And so consolidation seems inevitable. And this means that the smaller local brokerages are going to be absorbed. But this will actually help tap some of these untapped wealth in Chinese residents' wealth that we've been talking about. It's 15% of the securities and funds from the Chinese residents' wealth are just 15%. So to put that into a context, it's just 30 years before for U.S. levels. So there's a lot of potential for these money to flow into the capital markets, and they're exactly aiming for that.
Yeah, we have seen some consolidation, of course, among the big names already to create these global names. Yeah. Sami, fantastic. Thank you so much, Sami Cha, our Asia equities reporter on, I think that's a taking stock piece for today that looks at the brokerage story, not just the rally yesterday, but extrapolates into next year. Just look at markets, quiet day. This is the China Show. All right, about an hour and 24 minutes now into the cash market session. The big movers to the upside, financials and also biotech. There was a JPMorgan call, of course, in biotech. Deeper price cuts, but that doesn't actually mean deeper declines in the stock prices themselves. And as you can see, it's a financial story today as it pertains to that specific mover. Okay, what else is coming up?
RBA is coming up. It's been pretty interesting, right? We're just talking to Julio Callegari from JPMorgan. This is a narrative that's changing, right? We're not talking about rate cuts anymore when it comes to some of these central banks. RBA is certainly one of them where, given the hot CPI readings that we've seen of late, this is a market that is now pricing in hikes as early as March of next year. So that certainly is where the direction is. Whether economists and the RBA feel that way, we're not sure. So we'll look for a little bit more in the guidance a little bit later on.
Yeah, that's likely going to cement market expectations, if that is, of course, they're comfortable with. That's coming up, of course, later on. That's it from us still here on The China Show. We'll see you all tomorrow.